Direct government spending has long been the primary engine for defense manufacturing. A growing percentage of that funding now originates in the private retirement portfolios, 401ks, and daily bank deposits of regular citizens. This integration of global banking, venture capital, and arms production creates the military-industrial financial complex. It is a system where a standard savings account provides the liquidity needed to sustain a long-term conflict. This is a significant shift from the 20th century model. When President Eisenhower warned of the military-industrial complex in 1961, he was describing a system where the state paid defense contractors directly, subject to the friction of parliamentary debate and public scrutiny. Power shifted when Silicon Valley venture capital recognized the profit margins in defense technology. Firms that built their wealth on consumer software realized that AI and autonomous weapons could generate similar returns. Capital-light technology investors began absorbing the massive financial risks of prototyping and deploying new weapon systems, bypassing the slow grind of government procurement. War funding moved from a publicly accountable civic expenditure into a private, high-risk venture capital bet. This private momentum is being institutionalized through the Defense, Security, and Resilience Bank, or DSRB, a multinational entity designed to normalize war finance among allied nations. The DSRB raises tens of billions on global capital markets, issuing bonds to extend loans for weapon systems, supply chains, and allied defense infrastructure. By moving military borrowing into multilateral capital markets, the system insulates defense spending from the reach of domestic voters and parliamentary budgets. A single dollar deposited into a retail savings account doesn't sit in a local vault. It is pooled with millions of others into massive exchange-traded funds. When the DSRB issues bonds to fund the defense supply chain, these massive funds automatically purchase them. Major global institutions underwrite these bonds, making defense assets a foundational, highly traded component of global liquidity. This architecture seeps into major retail banking. Because these defense instruments are woven into the fundamental plumbing of everyday finance, individual moral divestment has become a structural impossibility. Integrating the military with global capital markets drastically lowers the borrowing costs for defense spending. When capital is cheap and readily available, the financial barriers to launching military operations are removed. We have seen what happens when military action operates on institutional momentum. During the 2003 invasion of Iraq, the central rationale collapsed under scrutiny, but the war had already been financed and executed. A highly liquid, financially optimized defense sector ensures that when a conflict sparks, geopolitical restraint is unlikely. There is a direct macroeconomic parallel to the 2008 financial crisis. Back then, complex mortgage-backed securities spread hitting risks across the entire banking system. That pre-2008 ecosystem relied on the assumption of ever-increasing real estate values. Today's military financial architecture requires continuous defense spending and sustained geopolitical tension to remain solvent. But what happens to this deeply embedded financial architecture if global conflicts actually de-escalate and the wars finally stop? By pricing global instability as a core driver of financial returns, we have engineered an economy dependent on warfare.